Hi, my name's Donmez, and I have the pleasure to be joined by Chris Mellor. How are you doing today, Chris?
I'm very good, thank you.
Brilliant. Could you just give a brief overview of what you do?
So I'm responsible for product management for the European equities business, ETF equities business at Invesco. So what that breaks down to is I'm an ETF geek, and I spend all my time talking about and playing with ETFs.
Brilliant. And can you give a brief overview of Invesco and how you kind of fit into that?
Yeah, so Invesco is about a $1.5 trillion asset manager, one of the world's biggest asset managers. And the ETF business, which I'm a part of, makes up about a third of the assets that are managed by Invesco for their clients. It's the fourth biggest ETF provider in the world and one of the biggest players in the European market. My focus is very much on European or UCITS ETFs.
We're going to be talking S&P 500 today. I think many beginner investors have heard of the S&P 500, but I think it would be great to hear from an expert. So could you just give a brief overview of the S&P 500?
Yeah, sure. So the S&P 500 is probably one of the best known market benchmarks in the world. And as the name suggests, it's simply taking the 500 largest stocks on the listed in the US across the NYSE, the NASDAQ, etc. And it gives a broad market cap weighted exposure to the US equity market.
Can you just dive into what is market cap weighted for those beginners?
Yeah, so if you look at what the index is trying to do, it's trying to represent what is the average performance across all of those 500 stocks. Market cap weighting is weighting by the size of the stock. So the number of shares multiplied by the price will give you the market capitalization of a company. And most of these broad benchmarks are weighted by that size. The way to think about it is if you were to invest in the whole of the market and own all of the shares in the S&P 500, obviously that's not possible to own literally all of them. That's the performance you would get.
Brilliant. And focusing or drilling down into that composition, what does the S&P 500 look like from a sector perspective?
Yeah, it's a pretty broad-based index, so it's made up of stocks from all of the sectors in the underlying US economy. And it's also worth saying that there's quite a decent exposure to international earnings as well, with many of those, the largest stocks in the US being real international businesses. In terms of sector exposure, the largest sector is IT, partly as a result of the outperformance from tech names in recent years, but there's also a big exposure to things like financials and healthcare and consumer stocks and so on. It's a pretty broad-based benchmark.
I think that's a really important and maybe overlooked point that you just raised about the revenue and earnings kind of exposure globally. Obviously, everyone thinks S&P 500, US stocks, they have revenue and earnings in the US, which is obviously true, but there's also a lot of international revenues that come. What are some of the biggest contributors of that overseas revenue and earnings for the S&P 500?
Yeah, if you think about the biggest names in the S&P 500, it's companies like Microsoft, which has been in the top 10 of the S&P 500 for decades now. It's something of an anomaly in managing that trick. Everyone, Apple users aside, will be using probably Microsoft software on their computer in pretty much every country around the world. It's also companies like Amazon, and again, I think everyone will recognize Amazon as a household name, probably have an account with them. So those kind of big multinational company businesses, a lot of them are big parts of the S&P 500.
And you've mentioned some of the biggest companies in the S&P 500. A lot of them are tech companies. So how does that compare to the NASDAQ, and how do you think about the differentiation between that so-called tech-heavy NASDAQ versus the S&P?
So really it's a question of scale. Both the S&P and the NASDAQ are exposed to the tech sector, and I've given some examples of some of the biggest names in the S&P 500 coming from the tech world. But if you look at the weighting of technology in the NASDAQ 100, it's something like 50% of the index is the tech sector. For the S&P 500, it's a lower number, a little below 30% or thereabout. So, by having 500 names rather than 100 names, you're getting a broader and more diversified exposure with the S&P 500. The other big difference between the two indices is the S&P 500 is drawing stocks from not only the NASDAQ stock exchange, which is what the NASDAQ 100 is doing, but also from the NYSE as well. So it's a broader and perhaps in some ways more traditional exposure that you're getting.
And those tech companies inherently have much richer valuations based on the growth story. And there's been an increasing, let's say, weighting in the S&P 500 from that outperformance. Is that valuation or those valuations a concern for investors? What are some of the considerations they should have?
If you look at valuations for US stock markets, the US stock market in general and the indices exposed to it, they are a little higher than other comparable regional benchmarks in Europe or Japan or the UK. And part of that is driven by a greater exposure to stocks in the tech sector, for example, and a greater exposure to growth stocks in general. And those stocks tend to trade on higher PE multiples. The reason being that what they're promising is stronger growth in the future compared to current earnings. And they're valued according to that. So US equities look a little more stretched than most other markets, but I guess the key question for investors is, is that justified by the stronger history of growth that you've seen and the hope for future growth?
We have interest rates in the US above 5% now. How does the composition of the S&P 500, how is it impacted by those higher rates? Obviously, it's got a different composition, energy, consumer discretionary. What's your kind of overview of where interest rates are and how that's affecting the S&P?
Yeah, so interest rates and the level of interest rates will affect different sectors, to a different degree, and it'll affect them in different ways as well. There's the sort of fundamental impact on financing costs for businesses. So, the costs of investing in new activities or meeting the costs of paying off debt that companies have raised in the past. And again, different sectors will have different exposures to that. You also see an impact on valuations and the willingness of investors to pay for higher future earnings, potentially, depending on what interest rates are doing. So when interest rates increased sharply in 2022, you saw a lot of growth names taking a hit to valuations. Obviously, with interest rates higher, there's the potential that falling rates, perhaps the coming year or so, could have the opposite effect on some of those more growth-oriented sectors.
Absolutely, and just to follow on from that, we have higher rates and the S&P 500 and NASDAQ and generally stock markets are having a great year. So do we actually need rate cuts at this point?
Oh, it's a great question. And I'll be honest, I leave that to the economists and the central bank experts. But in reality, I don't think you get rate cuts until inflation is clearly under control. Realistically, the reason for rate cuts is if actually higher rates have started to have an effect on the real economy and you're starting to see pressure in the jobs market, for example, and increasing unemployment rates. This has been a relatively benign period for the US economy. So, we've seen expectations for rate cuts pushed back as the first half of the year has gone through. And ultimately, that may be pushed back further. In reality, what you're really looking at from an investment perspective should be the very long term. So in the short term, there'll be impacts from movements in interest rates, but on a very long term basis, you should be looking at the potential for the long term performance of these markets.
Drilling down into that long term, what are some of the key drivers of the S&P 500 over that long term? Is it economic growth? Is it interest rates? Is it productivity? For those beginner investors that look at the S&P being a great long-term investment, what is driving this in the long term? Yeah,
the reality is if you look at the S&P, it's outperformed versus other benchmarks from around the world. And the reason for that has been multiple factors, but ultimately it boils down to better earnings growth. Valuations will fluctuate through the cycle and they will change depending on the makeup of the index. But the underlying driver of equity market performance is the earnings that are coming into those companies being reinvested or paid out to investors through dividends. So if you're delivering stronger earnings, you're going to deliver stronger stock market performance. The driver for those earnings is ultimately the underlying economic activity of the markets those companies are operating in. It's also linked to things like productivity improvements, and innovation in the way that companies are acting.
You've spoken to the market cap weighted, but there's also an equal weighted S&P. So what are some of the considerations and the differences between the two for that beginner investor?
Yeah, so as we've talked about, the market cap weighted index is giving a skew in terms of weighting, in terms of exposure to the largest stocks in the index. Equal weighting is kind of doing exactly what it says on the tin. Rather than overweighting the large stocks, you end up having an equal exposure to all 500 stocks in the S&P 500. What that means is that you're less exposed to the big companies, which can be good and can be bad. Over the last 10 years or so, mega cap companies, some of those names we mentioned before, have really driven the outperformance of the US equity market. And equal weight has not done so well. However, if you're concerned that some of those bigger names may have a bit of a pullback or may not continue to deliver on the expectations that are priced in, then an equal weighted approach is going to suffer less harm if they have a weaker period of performance.
And would it be fair to say that in periods of volatility, like we saw in 2022, for example, an equal weighted index is perhaps a better bet?
Yeah, it can be. What you generally find is equal weight will do better in those periods where the market is seeing a decrease in concentration. That isn't necessarily linked to specific market volatility, although 2022 is a great example where rising interest rates led to a pullback in markets in general, and it was more damaging to the large cap growth names in the S&P 500. So actually, the equal weighted version of the index outperformed meaningfully against the market cap weighted index, bucking the trend of the last decade.
So how do companies even make it into the S&P 500 index?
So in short, the simple version is that it's simply the 500 largest stocks on the North American Stock Exchange or the US stock exchanges. Areas like the NASDAQ Stock Exchange or the New York Stock Exchange, the NYSE. However, in any index, there is always a bit more devil in the detail, shall we say. So every index has a governance committee, and it's the governance committee that will judge whether a stock does or doesn't meet all of the rules for index inclusion. So while in general you're picking the 500 largest stocks by market capitalization, there may be some wrinkles along the way.
Is concentration risk a concern for the S&P 500?
It's certainly something that is worth thinking about in where you're putting your investments. And by concentration risk, what we're talking about there is if an index is dominated by the largest stocks or has a big exposure to just a handful of stocks. And certainly concentration concern has been growing for things like the NASDAQ 100 and the S&P 500 in recent years. That strong outperformance from certain large cap names, big stocks getting bigger, means that you're now in a situation where the top 10 stocks in the S&P 500 now makes up more than a third of the weight in the index because of that market cap weighting approach. And obviously, the bigger weight that they have, the bigger your exposure if they run into a problem. So you're getting more stock-specific risk coming into the index. To put that into context, by the way, the previous year-end high in terms of exposure to the top 10 names was at the end of 1999 as the tech bubble reached maximum inflation, and it was around about a quarter of the index was in the top 10 names. So it's quite an unusual circumstance right now. That's where equal weighting comes in. It's a great approach to reduce exposure to those big names while still keeping exposure to the broad range of stocks in the S&P 500.
So how does the S&P 500 ESG index differ from the S&P 500?
So the S&P 500 ESG index is designed to be close in terms of performance to the standard S&P 500, but overlaying a set of exclusion and ESG filters to give a better outcome in terms of ESG risk. So specifically, you're excluding certain business activities, things like companies involved in tobacco or weapons manufacturing. You're excluding companies that are deviating from global ethical norms, breaking UN Global Compact rules, and then selecting stocks based on ESG score. In terms of the number of stocks, you end up with something like 350 stocks approximately.
So what should investors consider when they're actually picking an S&P 500 fund?
So there are a few things to consider. The obvious ones that everyone looks at first of all is size, and size can make a difference, the margin, but ultimately for an ETF, once it's past a few $100 million, it's going to be of a scale that it can replicate pretty decently. The second one is fees and the costs associated with the fund, and certainly I think fees are an important part of the selection process, because all things being equal, a fund that's charging 0.05% versus one that's charging 0.15%, all things being equal, the cheaper fund should do better. But ultimately, I think the key thing you should be looking at is the performance of the fund, because realistically, the final thing that you're caring about is how much return you're going to get in your portfolio. And different funds will deliver different performance because of things like differences in fees, differences in the cost of replication, trading the stocks within the fund, or indeed, in the case of swap-based ETFs, better withholding tax rates that may be available.
So you've mentioned potential outperformance. Can you dive into that a little bit?
So ultimately, the performance of a fund depends on a number of factors. Fees is the obvious one that people think about, but often tax is an important implication, and specifically withholding tax on dividends. So if you're investing in a US exposure like S&P 500, the tax authorities in the US will be wanting to take their share of tax, typically withheld at 30%. If you're investing in a physical fund with a sensible domicile, so for example, based in Ireland, where there's a tax treaty in place, you can reduce that withholding tax to 15% rather than 30%. If you invest in a swap-based ETF on certain benchmarks like the S&P 500, it's possible to reduce that withholding tax rate to 0. That adds up to a significant degree of performance. If you had a 2% dividend yield on the S&P 500, it's adding something like 0.3% to performance. Dividend yields are a little low at the moment, but it's still adding more like 0.2% to performance every year at current levels.
So you've talked about tax. What does this actually mean in practice for the average investor?
So ultimately, there are 3 levels of taxation you have to think about in investment. The first is the fund level, so what taxes are withheld by investing in a stock, or when you're investing in a stock, or when the fund is investing in a stock. The second level is the portfolio level taxation, so when the fund is distributing or reinvesting income received from the stocks it holds. And then the final level is the final end investors taxation. Obviously for a fund, I can talk about the first 2, individual level taxation. I can't really comment on. I'm certainly not a tax advisor. But if you're holding a stock in an ISA, that helps to moderate that individual taxation level.